want to look at the origins of the 4% rule, other data that's come out and studies on it recently, some of the drawbacks, and whether that rule makes sense in today's environment. So, the 4% rule was created by Bill Bengen, a financial advisor back in 1994. And he put out a research paper that studied historical data on investment returns and inflation. And what he found was that if a retiree took a 4% withdrawal rate on their investment portfolio, that portfolio would have lasted at least 33 years in every historical scenario up to that point. And in fact, in most scenarios, that portfolio would have lasted 50 years or more. So that's where the 4% rule came from. Now, if you kind of put that in practice, imagine somebody had $1 million portfolio. In the initial year they retired, they would have taken a $40,000 withdrawal. If inflation was 4%, they would bump that withdrawal up by 4% the next year, and then so on and so forth. Now, that rule has kind of been studied a lot ever since. There was the Trinity study famously. Now, that took into account more asset classes, and it was done by three professors. And that more or less confirmed that, hey, a 4% rule has been really successful in the past. And one of the things I actually wanted to point out was this chart from McLean Asset Management, and they updated Bengen's data through 2010, and they came up with this chart showing the maximum withdrawal rate depending on the year that you retire, and you can see it's kind of been up and down anywhere between 4% and as high as 8%. Kind of depends on what investment returns were over the 30 years, and very importantly, how high inflation was. One of the most damaging things to safe withdrawal rates is high inflation, especially early on in retirement, because that bumps up those withdrawal rates early and it makes it difficult for the portfolio to keep up.